brief presentation on the financial statements or financial reports that we need to make sure we feel very, very comfortable understanding what the financial statement or report is all about, what goes into each of the reports, and so on. This is a brief summary of things that I believe that you should know if you want to be successful in 2021 and afterwards in 2071, right? The first thing you need to keep in mind is that, as I told you the first day of class, accounting is the language of business. Another definition will be accounting is the three R's. We have an accounting information system where we record transactions, financial events into this accounting information system. So at the end, we can end up with financial statement reports. So we record to prepare reports. If you did a good job recording everything, taking into account all the adjustments, taking into account a group of accounting and so on, you will have reports that are very valuable. And then you can proceed to the third R, which is review. You will review the financial statements and take decisions, important decisions like expanding, growing, selling your business, and so on. So let's just get back to the financial statements or reports. The names are, the basic four reports that you need are the income statement or profit and loss, retained earnings statement, balance sheet statement, and the last one is the statement of cash flows. I don't really spend too much time on statement of cash flows, since when you take 2071, the second accounting class, we will actually have a whole chapter dealing with the statement of cash flows, and we'll learn how to prepare one um, with the information that they're going to give us, okay? So for now, let me just briefly tell you things that you should know that are going to make things a lot easier. The income statement, another name for income statement will be profit and loss. So the income statement is basically a report that would tell the stakeholders how successful, how much profit resulted from running the business. In this example, we have a profit and loss for Net Solutions for just 1 month, 30 days of November. So once again, the income statement is always going to say for month ended, or for year ended, or for quarter ended. So it's basically showing what actually happened for a period of time, and it's obviously going to give us the amount of income or loss, net income or net loss, based on how much revenues were earned, fees earned were earned, sales if we're dealing with merchandise, against the expenses for the same accounting period. If you did a properly good matching, I'm going to tell you about that in a few minutes, in a few seconds, you will have a perfectly matched income statement for November. So what do I mean by matching? Matching is basically chapter 3, which deals with adjusting entries. Because we have customers that might be paying us for our services in advance, and because we might have customers and clients that will pay us after we do the work, all right? And also because we have expenses that we are going to incur for the accounting period, let's say November, but we're going to be paying for them later, and because we're going to have expenses that are not expenses incurred yet, and we're going to pay for them in advance, because of those four things, we need to make sure that when we prepare this income statement, we're taking those four things into account to only show fees earned revenues for 30 days of November. So in other words, excluding any customer that has paid us in advance, which is basically unearned revenue, and including all fees earned even for those customers that we have not paid us, but that we did earn the revenue in November. So again, you will learn how to do that when we do chapter 3 and we record adjusting entries. But once again, I need to make sure that fees earned, the total amount of fees earned, this number is fees earned for 30 days of November, including all revenues earned, even the ones that have not paid us yet, customers that haven't paid us yet, and excluding any customer that probably paid us in advance before we did the work. All right. Now, If you do a good job doing that, then the next step is making sure that the expenses for this same 30 days are expenses incurred, which means expenses that were uh, basically that took place, that were incurred during the same 30 days of November, including all expenses, even if you have not paid for them, they need to be included here, and excluding any expenses that maybe you've paid for the expense in advance, like prepaid insurance. We cannot include the total amount of prepaid insurance here, only the amount of insurance expense for this 30 days of November. So again, you will learn how to do that when we do chapter 3, but the main point right now is that this income statement needs to be prepared under the accrual basis income, which is showing only revenues earned for 30 days, expenses incurred for the 30 days, and then you will have a properly matched income statement that shows that your income for 30 days of November was $3,050. The next statement that you prepare after having the income statement is the retained earnings statement. Before we continue, I want you to know that the income statement, all the accounts that you see on this report are temporary accounts. We keep track of fees earned and expenses temporarily, just for an accounting period. At the end of an accounting period, let's say a year or a month, but usually a year, all the temporary accounts are closed into retained earnings, which is a permanent account. All right, so we will be doing this when we go over chapter 4, but in the meantime, just know that retained earnings increases at the end of every accounting period when you have income, decreases when you have a net loss, which means that you had more expenses than fees earned, and retained earnings also decreases with dividends. So retained earnings is a permanent account that the balance carries over from one period to the next. So you can see that for Net Solutions, since this is a brand new company, the company started with a zero balance. We added the income for the month of November. We deducted the $2,000 of dividends that the owner took out in the form of dividends, and we end up with a net increase of retained earnings from 0 to 1,050, which is the ending balance. By the way, this number will be the beginning retained earnings balance. When we do this for December, this number will become our beginning balance. We will add the net income for December, we will deduct any dividends for December, and we will end up with the retained earnings December, and that whole process continues. One more thing, the third financial statement that we need to spend some time on is the balance sheet statement. This is basically the accounting equation. Resources owned by a business, liabilities, and stockholders' equity. This report is not going to say for year ended, or for November ended, or for month ended. It's going to always say, you don't see it here, but it would be even better if you put here, as of November 30th. It's taking a picture as of November 30, how the assets, liabilities, and equity will be at this point in time. Not December 1st, not November 28th, no, as of the November 30th, what are the resources owned by the company, what are the liabilities, and what is the stockholders' equity. One more thing, the stockholders' equity, I'm going to prepare another brief video telling you how to solve for net income when they give you 4 different scenarios, 4 combinations between capital stock and dividends, and you need to solve for net income. So again, watch out for a presentation video on how to solve for net income. I think it's exercise 1-15. But anyway, before you answer, before you do that type of problem, you need to really understand what makes up equity. Equity is common stock, or the owner's investment, or the issuance of common stock, and retained earnings. Those two together will make up equity, which, by the way, is basically the amount that the stockholders will expect to get as of November 30th if the business were to close down, or let's say that they would sell it, they would like to get at least 26,050, which again for Net Solutions will be the combination of the common stock, which is, I'm assuming I can basically come to the conclusion that up to November 30th, the owners have put in, through most likely common stock, issuance of common stock, $25,000. And then from the result of running the company and doing a good job as far as income, and basically the dividends, again, is the result of the 3,050 minus the 2,000, The net increase to retained earnings for this accounting period, November, is an net increase of 1,050. So this concludes the first presentation on financial statements. Let me know if you have any questions. Thank you.